Yeah, so Ranjan's right. I've known him since about 2002, before the grey hair and the groupies. I have to wait in line now to talk to him. Thanks for the introduction, and thank you for everybody for coming. My journey started in 2001. I studied finance at Manchester. My goal was to try and get into the city and get a high-paying job. The stock market had just crashed. There weren't any jobs going at the time. So I thought I would try my luck at starting a business. Looked around, thought what works for other people. Lots of rich people own houses and properties, and the internet was kind of a fad at the time. So I thought I'll try and combine the two. And I just stumbled, luckily, upon a whole bunch of American internet discussion forums. The one I'd recommend reading is called dealmakerscafe.com. There's another one called creonline.com, CRE, stands for Creative Real Estate Online. And just a place where American investors were kind of just discussing how they do things. And my thinking with that was, if I just kind of follow what everybody else in this country is doing, I'm not going to do anything different or better. I need to look elsewhere. And so what I learned was a whole bunch of marketing techniques that nobody was using here. So at that time, Google was kind of just becoming popular, and there was a whole bunch of other search engines and things. And people in America were advertising online so if somebody typed in, I need to sell my house fast, they'd put an advert which said, free report reveals how to sell your house in 7 days or less at no cost to you. And I told a few people here, I'm going to try this. And they said, who's going to believe that? It's too American. It's not going to work. But I did it, and it worked. And it worked so well that I had more properties coming to me from people who needed to sell them really fast and really cheap than I had the money to buy them. So I was stuck because I had no money. So my thinking at the time was, I'm going to go out and network and meet people in London. So I used to go to angel investing events in London. That's how I kind of got to know Vanish, who's sitting over there. He was running one in Kensington at the time, and there was a minimum requirement of you've got to have £100,000 to invest. I didn't have £100 to invest, let alone 100,000. But I just thought, well, I'll just go along, dress in a suit. How are they going to know I've got no money? It was great. I met my first investor there. Somebody came up to me afterwards and said, if you ever need a few £100,000 in a week, give me a call. That's what I do for a living. And that got me going, because then I could use their money to buy properties, and then I could refinance them and keep them. So about 2003, I wrote a book called Success Through Property, which kind of became sold a few thousand copies. It became a bestseller in that very small niche of people who buy distressed properties. And that was completely by accident. I didn't intend to do that. The reason I wrote a book was people kept asking me how I do this internet stuff, and I just thought I'd get them off my back. And the book went on from there. Then Ranjan, myself, and Vanish did lots of events all over the country, Property Investor Show, if anybody's been there. So we started doing workshops and training, and it all just kind of carried on from there. 2006 was when I met my wife. I was very lucky because you've all heard of arranged marriages, right? But they're not arranged marriages as such. They're arranged meetings. They just kind of put you together, two strangers, and see if you hit it off. And I sat with her, and she didn't really know what I did. So I hadn't told her yet, but I said, what do you do? And she said, oh, I'm a solicitor. I said, okay, what kind of solicitor? And she said, I'm a property solicitor. I thought, okay, that's interesting. I thought, what exactly do you do? And she goes, I'll keep it really simple for you, but you know these big land developers? One of them was her firm's client. I won't mention the name. And she said, well, when they're buying, building these houses, they don't buy the land. They get this thing called an option, and they control the land, and then they do all this stuff. And I do that work. I was like, okay, interesting. So driving her home that day, first time I've met her, I asked her to marry me. She said yes, and we were married within 6 months. And the property lesson there is, if you see a good deal, don't hang around. So I'm here today with two of my business partners, Adam, who's over there. We own a letting agency together. We manage about 120 properties. The really interesting thing we're doing in our letting agency is we have an institution we're working with. They have a £100 million budget, and we're sourcing them properties mainly in the Leicestershire area. And since December, we've sourced them. They're buying about 40 properties now through us. So if you're thinking of working with large institutions to sell properties, then Adam's your man. He can help you understand how that works. And then there's Mark, I also work with a lot. He's over here. He's an ex-Accenture consultant, worked at UBS Wealth Management, has a maths PhD, can fix your spreadsheets. But he's great for understanding risk and things like that. And that's kind of what I spend my time doing. So a wise man once said, there's only 3 ways for a man to go broke. There's liqueur, ladies, and leverage. And leverage is the one I'm going to talk to you about today. Because we all need leverage, and that's why we're here today, because we can use other people's money to make ourselves money. And but the trouble is, our leverage that we're using is quite inflexible in the sense of if you were to go to the USA, you would be able to get a 30-year fixed-rate mortgage at a very low rate. So they're kind of insulated from all these movements in interest rates. So you wouldn't need this talk over there because people don't have to worry about where interest rates are going to go. So they have 30-year fixed rates. We don't. We have 2, 5, maybe 10. Their fixed rates are relatively inexpensive. Ours are relatively expensive compared to the floating rates. And also, our redemption penalties are very high. If you pay that loan off earlier than the fixed rate period, you get whacked with a big fee. They don't have the redemption penalties either. So they're very lucky in that sense, and we're not. So leveraging is important to us, but it's a risk we should be very careful to manage. And I'll talk a bit about how we can do that. So in answer to the question, will an interest rate rise, crash the property market? I hope so. And I'll clarify. So the key question is, will rates rise slowly or very quickly? Because if they were to rise very quickly, as they did in the early 90s, does anybody remember that time? Or were they involved in property at that time? They went up to 15% in a day. And a lot of people were in big trouble and were repossessed. And lots of people got wiped out. And the banks learned their lesson in 2008. So they didn't repossess all these people because they realized if we repossess them and then dump all the properties on the market, they don't sell. We have to take big haircuts. So what we'll do is we'll rearrange the terms and keep these properties on our books for now. And they're also lucky that interest rates dropped. And that's an important thing we'll come back to in a second. So it's very important that I think you think about how you're leveraged and how your capital structure works, because for some of us here who don't have high gearing, it's not really an issue if interest rates go up. But for others who have come into the market relatively recently, especially if you're on interest-only loans, things like that, then it could be something you need to stress test your business and really think about how you can deal with that. And already we're seeing, I mentioned in the last slide, Section 24 tax changes, the new PRA rules, the 3% stamp duty surcharge. And these things are already having effect. This is only 2017 third quarter. And already you're seeing a huge reduction in the percentage of all loans going to buy-to-let. And that's having an impact. I don't personally think that's such a bad thing, because as I said in my last slide, the more competition is reduced, the better for us. If you're a long-term investor, you're trying to buy properties, you want less people to compete with, not more. So that's my thinking. So a lot of people don't realise, of the, say, 5 million odd properties in the UK that are rented out, 65% of them have no mortgage whatsoever. Of the remaining 1.75 million or so, there's only leverage of about 45% on average across those properties. So really, it's the people who've entered relatively recently into the market or have refinanced relatively recently, so they have larger loans, and if they have interest-only loans, they're the ones who are going to be disproportionately impacted when it comes to the total. It's one of my favourite sayings, because it's true. So one of the things that I spend a lot of time doing is looking back and trying to understand how things have gone in the past, to try and think about how things might work in the future. So if you're looking at interest rates, over the last 120 years, they've actually, the blue line is the interest rates, red is inflation. They've actually averaged about 5% over the 120-year period. And this is the period we're in now. It's a very, very small part of that. And I think the danger is there's a lot of investors investing based on this rather than that. And I think that's where the danger lies, because stacking up deals based on rates being historically low and remaining there is potentially a dangerous thing to do. It doesn't mean you shouldn't invest, it just means you should invest differently and try to insulate yourself from some of these issues we're going to talk about. Now, that's the rate of growth in rents and house prices, and you can see how they've kind of just decoupled from each other. And I think a lot of that, I'm sure we've all seen this if you go to auction rooms or you're trying to buy properties, is low rates have pushed a lot of people into property who otherwise wouldn't have been there. If you have money and you want to do something, you want to get a return on it, you can't leave it in the bank, you wouldn't necessarily buy bonds, you might not want to put it in the stock market. Property is a natural home, and I think that's where a lot of this for us, has come from. So I think the whole idea of buying a house, renting it out to a family and getting a 75% loan, it doesn't really work anymore, especially in somewhere like London, where once you apply the new PRA rules, and you stress test at 145% on the rentals, at 5.5% interest rate, it just doesn't stack up unless you're putting down huge deposits, which kind of negates the whole point of buying the property in the first place. So we refurb and sell properties. We did 5 last year. I think we're just finishing off 1 this year. Even that's kind of become really competitive, again, from people who are just trying to get a return on cash. And so you have to go above and beyond the traditional strategies. And this is the kind of thing Ranjan was talking about, and the previous speaker was talking about in terms of being creative in planning gains, title splits, build to rent, commercial conversions, and that type of thing. So in terms of like being creative, let me just give you some ideas. I mean, I don't just invest in property, I invest in pretty much anything that I think can make a good return. And so, one of the things when you're looking back at history and you're kind of understanding how things might pan out in the future, a good example is history. As I said before, history repeats itself. And one of the important lessons we learn from history is when big reputable companies have a misstep, they tend to correct it and move on and carry on like before. And so 4th of October 2015, you can have a look at my Facebook post. I bought VW shares, for example, right at the bottom, almost right at the bottom after you'll remember the emissions scandal and everything else. Made an easy 25% on my money, tax-free, because it went through my ISAs in about 4 months. In hindsight, I should have just kept them because they've carried on going up. But it's a good example of how creative thinking and understanding how things work in the past can help you make good decisions for the future. And that's an example of how I did that. Chinese stock market was another example. Once you understand price-to-earnings ratios, you see that when stock markets start to go past about 30 or 40, it's kind of an indication of very speculative activity because people aren't really paying for what the asset earns, they're paying for what the asset might be worth in the future or what they can sell it for in the future. I think the Chinese technology market, the stock index got to about 185 price to earnings, some ridiculous number like that at the time. And that's when I spotted it. It dropped by half in a matter of months. And so again, it's useful to understand these ratios, and when they start to go out of whack, whether it's in property or shares or anything else, you can start to get an indication of what might happen next. There's no guarantee, but you can at least say this looks expensive with a fair degree of surety. Bitcoin is another one. I wrote a blog on this on the 12th of November. It was at about there, I think, so I was a bit too early, but really I wasn't trying to put people off, because I'm sure there's people here who love it and think it's the best thing. And if you're sophisticated and you understand it and you've got money to spare, then good luck to you. I think I was more trying to warn people who think it's a bit like property, or it's a bit like buying a big company and you're not going to lose all your money. Well, you could if you're not careful. And it kind of went up and then just crashed by about 2/3 in a space of a matter of a few weeks. So I'm just trying to warn people to be careful. And once you understand some of the things I'm talking about, it's not hard to spot that and avoid it. So the question is, when you're coming to thinking about the future and interest rates and what might happen, who should you listen to? Well, I actually took these 2 articles here, both from The Guardian, about 4 days apart. One says UK house prices fall again, The other one says surprise rise in UK house prices. So, who do you believe? And really, the conclusion I've come to is you've got to just make your own, do your own analysis. But it doesn't need to be complicated. I'm not building huge, complex spreadsheets or anything like that. Just a bit of common sense. So, property prices in nominal terms since the 1980s have gone up around nearly 12 times, and wages have gone up only about 6.5 times. So it's quite clear to see that people are stretching a lot more than they would have done in the past to buy a property. In London, if you look at the stats for the early 90s, just after the crash, about 95, I think it was, you could buy the average London house for about 3 times the average person's income in London. Now that number's 15. So it just shows you. In fact, there's a really good chart you can go on. If you go to The Economist, you just go into Google and type in Economist Real Estate Index, I think it's called. And you have lots of fun comparing average price to income ratios. And you can see how expensive relative to other countries Britain is and how it's kind of changed over time. And you can see prices versus rents and all sorts of interesting things. It's good for the nerds amongst us. So my point is, interest rates rising now will have more of an impact than they would have done then, simply because people have stretched so much more to afford a property. Obviously, it doesn't apply to everybody, but I'm just talking on average, in aggregate. The other thing is people are in a precarious position. Generally, UK household debt has gone from about 30% to GDP to about 90% now. And the question is, is that sustainable? And would it be resilient to a shock to the market, whether that's interest rates going up or something else? So a lot more people got wiped out in the early 90s there than they did in 2008. And like I said before, banks learnt their lesson and didn't go out and repossess a whole load of people. That's actually... that's the properties taken into repossession there in red. So you can see the difference in numbers. What that meant, Ranjan and I were talking about this, what that meant in 2008 was a whole load of people who should have really gone under because they'd made a whole bunch of mistakes and bought things they shouldn't have done, actually thought they were really clever by the time 2010 and 11 came along, because the rates went down to nothing and they had these properties that they really shouldn't have. And they were sitting pretty for the next 8-9 years. And there's lots of them around. Might even be some here. We've all got an element of that in our... some of us have got an element of that in our portfolio, but who've been around a while. But that was just luck. It wasn't that we were skillful landlords and really clever. It was just very, very lucky, because it could have easily gone the other way. So I'm not saying there'll be a wave of repossessions or anything like that, because I don't know if there will be. Who knows? But I do think there is an opportunity that I think people should think about. So I'm a help-to-buy registered developer. So I've built properties and I've sold them on to people who got help-to-buy product from the government. And they're only putting down 5% deposits. They get 20% from the government, interest-free for 5 years, and then they get a 75% bank loan. So you'd think they'd be the people who would be kind of stretching themselves. But actually talking to them and looking at their finances, they're pretty sensible people. We, as part of our letting agency, we own an estate agency, and we get to see lots of transactions there. Adam's probably sold 300-400 houses, so he knows a lot about people's behaviour. Generally, in terms of the average person buying a house to live in, they're pretty sensible people. They're not going crazy in terms of stretching themselves. It's actually the investors who are the crazy ones. I don't know what your experience is, but if you've been to auction and you valued a property at what you think was a sensible price to pay, actually, has anybody had this experience where you've gone for a property and you've kind of valued it at a point where you think that's a pretty sensible price to pay? You go for it and it just goes for some insane figure that doesn't make any sense whatsoever. Okay, so half the room are nodding their head, and we have that, where we are, and you just can't make sense of it. How did somebody end up paying that much? And again, I think in the investor space, a lot of that is just down to people are comparing the deal they're getting, even though it's insanely expensive, with getting 0.5% in the bank. That's their comparison. if I'm getting 0.5% in the bank, what's wrong with getting 4%? It's 8 times as much as I'm getting in the bank. Why not? And the risk seems very little because people's memories are short. So they're only really looking back, the average person, say, 6, 7 years, and interest rates have been low all that time, property prices have been going up. It seems like a worthwhile thing to do. But that risk hasn't gone away. In fact, it's probably built up to a point where at some point it could snap and hurt people. So first of all, make sure you're not going to be a victim if rates were to go up. And secondly, make sure you can capitalize on that. Because I think I know there's a whole bunch of property investors, hopefully not the educated ones here, but other ones around, that we've seen doing crazy things just for very low yields, who have stacked their rental income calculations on historically low borrowing rates, and that's their plan. I mean, I've actually seen this with people building huge developments. That's what they've banked on, and if they've not really thought about where rates could go and how that would affect them. Most of those guys are on what I would class as actually quite expensive commercial borrowing. When you look at these products, they're not cheap, and they're pretty expensive when you add in all the admin fees and everything else. And some of them, I don't know how many of them, but quite a few of them have actually valued the asset based on a commercial valuation versus a bricks and mortar valuation, because you get more money back, you get more money out. And that's fine if the income stream is there, right? But there will be cases where, for example, say somebody's done a big HMO, the council comes along and wants to band the rooms individually, that's going to destroy that cash flow for that business model. The cash flow is gone, not gone, but it's been damaged, and that asset now, what happens to it? Because you've borrowed a lot of money against it. So I think the opportunity here is look around for investors who bought things and they've bought them relatively new at financing that won't sustain. And they're I think they're some of the deals that we should be looking at going forward if rates were to go up. So just some things to think about. I think if rates rise, we could see repossession rates shoot up. I don't think across the whole market, but just in some of the investor-led type opportunities, especially where people have bought for yields and things change. I mean, we're already seeing portfolios come up in our area. And you might argue, if a portfolio of HMOs, say, came to me, what would I do with it? Because I don't want to be lumbered with the same problem that person has. And that's where you've got to be creative. That's where you've got to be educated, because those properties could be refurbed, split into flats, or they could be just converted back into normal houses and sold on. If you've bought something at a really good price, then you're kind of banking that, you're factoring that in, that you can do something with it and reposition those assets to do something else. If rates rise gradually, I think that people will adapt. I think that will be absorbed by the market, and that should probably be okay. The Brexit effect, that's something nobody really knows what's going to happen there. But it's worth planning. I mean, are you very reliant on Eastern European tenants, for example, and how might things change if they have to go back? And they already are going back. So, how does that affect things? Most people hate the idea of a Corbyn government, but actually, is it such a bad thing for somebody who's in property for the long term? For the long term. In the short term, it will put a lot of people off property. And it will mean, potentially, you go for a deal, you're not competing with as many people as you might have been otherwise, because they think property is a terrible thing to do. I don't know. It's worth thinking about, right? So, some of these things will actually help rather than hinder, but you have to have the right mindset. And I think you also have to obviously have the ability to go and move on these opportunities. So I think one of the big things most of you should be thinking about is, how do I work with investors? How do I work with funding sources? Because there's no point, there's distressed properties around, but you can't buy them. It doesn't make a difference to you. I mean, you want to be in a position where you can get hold of them. So just some strategies. Stress test your business on different rates of interest and how that might affect things. Obviously, for most of you guys, plan for Section 24 tax changes and how that's going to affect you, the high-rate taxpayers in the room. Really big one, get investors and JV partners in the room, talk to people in the room who understand how to raise finance. you might want to go ahead and look for high-yielding properties, because if London doesn't stack up for you, there's other areas, but that's an added level of complication. So look for people you can trust and you can work with who can do that, and you can partner with them. I mean, one of the things that we do is we're in an area where the yields work, and we work with London investors who come and work with us, whether it's putting money up or we joint venture with them, and that works really well for us. You have to become more creative. As Ranjan said, the traditional strategies won't work, and you have to be educated and know how to do things differently. So just finally, I put a form out, so if anybody wants a free video that I've put together, I'll send you that, and I'll drop you an email. I'll also give you an opportunity to come and have a look at our deals in Leicester. We have a letting agency. You can come and have a look at how we do things and the kind of properties that we source. So, thank you.
Brilliant.